Imagine waking up one morning to find that one of the most trusted names on Wall Street has been running the biggest Ponzi scheme in American history, right under the noses of regulators. Bernie Madoff, once hailed as a financial wizard, orchestrated a fraud so massive and so deeply rooted that it became a case study in how the pursuit of trust and reputation can blind even the most sophisticated investors. This is not just a story about greed, it's a story about the failure of oversight, the human cost of deception, and the staggering power of perception in the world of high finance. Madoff's scheme ran for decades, ensnaring celebrities, institutions, and families alike. But how did this happen? How did Bernie Madoff, the son of Polish immigrants, rise to control a $65 billion illusion? And how did the Securities and Exchange Commission created to protect the little guy miss all the red flags waving in plain sight? The answers lie in a world where trust is currency and skepticism is too often in short supply. Let's rewind to the 1960s when Madoff started his investment firm with just $5,000 he earned from lifeguarding and installing sprinklers. In a few short years, he built a reputation for reliability and consistent returns, offering clients steady profits even when the markets were in turmoil. His secret seemed to be a mysterious investment strategy called split-strike conversion, but in reality, it was smoke and mirrors. Instead of investing client funds, Madoff paid old investors with new investors' money, a classic Ponzi scheme. But this was no ordinary fraud. Madoff exploited his social connections and cultivated an aura of exclusivity, creating waiting lists for those desperate to get in on his funds. The more inaccessible he seemed, the more people wanted in. This psychological trick is age-old in sales and high finance. The best opportunities are often those you can't have. By the 1980s, Madoff's stature grew as he helped pioneer electronic trading and served as chairman of NASDAQ. Ironically, his legitimate business innovations helped mask his illicit activities. He was respected, influential, and, most importantly, trusted. But beneath the surface, the numbers didn't add up. Several whistleblowers, most notably Harry Markopolos, raised repeated concerns to the SEC, arguing that Madoff's returns were mathematically impossible. Markopolos' detailed reports, submitted for nearly a decade, went largely ignored. Why? Because Madoff's reputation was impeccable. He was a Wall Street insider with connections at every level, and regulators often deferred to his authority. There's a lesson here about incentives and the dangers of groupthink, especially in environments where success is measured in dollars and prestige. The SEC's failure wasn't just incompetence, it was also a product of a culture that values reputation over scrutiny. Madoff's firm was subject to multiple investigations, but these were superficial at best. The investigators missed basic telltale signs, such as the absence of trades in the records or the use of a tiny, unknown accounting firm to sign off on billions of dollars in assets. It's tempting to blame the regulators entirely, but Madoff's clients, many of whom were experienced financial professionals, also failed to perform basic due diligence. The herd mentality is powerful, and Madoff was a master at manipulating it. His client list included everyone from Hollywood moguls and Nobel laureates to pension funds and charities. For years, these organizations enjoyed steady, above-market returns, even as competitors struggled. Few asked questions, fearing exclusion from Madoff's inner circle. When the financial crisis of 2008 hit and too many clients tried to withdraw funds, the house of cards collapsed. In December 2008, Madoff confessed to his sons, who turned him in to the authorities. The fallout was immediate and catastrophic. Billions of dollars vanished overnight, with victims ranging from billionaire philanthropists to retirees who lost everything. The human toll was staggering, with lives upended and at least 2 suicides directly linked to the scandal. But what's perhaps most shocking is how preventable it all was. The SEC's internal review later admitted to multiple missed opportunities to unmask the fraud. Some investigators didn't even understand basic financial products. The Madoff scandal exposed systemic weaknesses in regulatory agencies, forcing a painful reevaluation of oversight in the financial sector. It's a powerful reminder that markets work best when incentives are aligned and transparency is enforced, not when reputation substitutes for real accountability. And yet, the story is layered. Madoff's legitimate market-making business provided real value to the financial ecosystem, driving innovation and liquidity. It's a paradox that the same drive for competition and efficiency that underpins free markets can also enable deception when checks and balances break down. In the aftermath, reforms were enacted, whistleblower protections were strengthened, and due diligence became a buzzword across Wall Street. But can any regulation fully eliminate the risk of fraud, or is skepticism and personal responsibility the ultimate safeguard? The Madoff saga serves as cautionary tale for investors everywhere. Trust, but verify. Even in the world's most sophisticated markets, the allure of easy money can cloud judgment. The free market's greatest strength is also its greatest weakness. It relies on trust. But where there is trust, there must also be vigilance. And now, a quick pause. If you're finding this story as mind-blowing as we do, hit that like button, subscribe for more deep dives into the world of finance, and drop a comment letting us know what story you want to see next on Fortune Route. Back to the story. In the years since Madoff's arrest, efforts to recover stolen funds have led to the return of billions to defrauded investors, but not everyone was made whole. The impact rippled through the financial world, prompting not just regulatory changes, but also a cultural reckoning about the nature of risk and reward. The Madoff case is a stark illustration of how human psychology, institutional inertia, and misplaced faith can combine to create the perfect storm. It also underscores the immense responsibility that comes with financial freedom. In a capitalist society, innovation and competition drive progress, but they also demand personal due diligence and critical thinking. The lesson here is not to abandon trust, but to exercise it wisely. Madoff's story is a warning, yet it's also a testament to the enduring power of markets to correct themselves, painful though the process may be. As we reflect on the largest Ponzi scheme in US history, we're reminded that the pursuit of prosperity is fraught with risk, but that risk, when managed wisely, is what allows civilization to progress. At its core, capitalism thrives on the creativity and ambition of individuals, qualities that can be used for good or ill. Bernie Madoff's rise and fall is a lesson in both the dangers of unchecked ambition and the resilience of the financial system. The free market, for all its flaws, ultimately exposed Madoff's deception, even if the process was slow and painful. If you've learned something new today, share this video with a friend, hit like, subscribe to Fortune Route, and tell us what finance mystery or business legend you want us to cover next. Don't forget to turn on notifications so you never miss a story that could change the way you see the world of money. The story of Bernie Madoff is a reminder. Vigilance, transparency, and a healthy dose of skepticism are the real guardians of wealth. Stay curious, stay informed, and until next time, keep seeking the fortune route.